This week, Ben and I are going to talk about the U.S. ag trade deficit expected for the upcoming year, along with some tariff discussions and then some ethanol and energy discussion as well. Hello and welcome to the weekly commodity market update. I'm Brownfield's Will Robinson, joined as always by the University of Missouri's Ben Brown. Ben, how's it going?
It's going well. How are you today, Will?
It's going all right. It's a unique morning down here in Central Texas as we have somewhat heavy rainfall going on right now at 6:44 in the morning. So it's kind of
Yeah.
nice.
It's raining here in central Missouri this morning, too. I love thunderstorms. We didn't have a whole lot last year, so it's nice to see a thunderstorm come through this morning. Definitely starting to feel like spring.
Yeah, well, as we kind of move into that spring, these showers are going to be more and more impactful going into the growing season on expected moisture and, how all that kind of plays into the market. But before we dive into today's topics, I'm going to give a quick recap on the market. Now, this is as of Friday's close, so we did see some continued changes, hard shifts on the open this week, looking at Monday, but week over week, looking at May corn from Friday down 36 cents at 469. December corn was down 15 cents at 455. May soybeans down 32 cents at 1025. November soybeans down 30 cents at 1029. Soybean oil on a cents per pound basis for May down 3.22 cents a pound at 44.12. Soybean meal by the short ton for May down $3.70 at $300.20. Wheat for May, looking down 49 cents at 555. July wheat down 48 at 569. That March cotton crop down 2.09 cents a pound at 65.25. December cotton down 1.27 cents a pound at 67.88. And then that West Texas Intermediate crude oil contract down 88 cents a barrel at 69.34. So Ben, looking back at the close last week, a lot of losses across the board and then some more losses to open up this week. The markets seem to be now kind of trending downward. What's your overall takeaway?
Well, you're right. So you mentioned we're down again to start the week. New crop soybeans getting really close to that $10 mark on the futures board. And then the old crop soybeans already below $10. So I'm sure there's actually quite a few farmers breathing a sigh of relief that this market kind of downturn is happening after the spring crop insurance guarantees are set. So that happened during the month of February. Those are now set. Although for soybeans, they're a full dollar lower, just a little over $1 lower than where they were last year. But still, I think getting the crop insurance guarantee set before this downturn, I think is probably a welcome sign to a lot of producers.
Well, Ben, I feel like we have a lot to talk about within the same vein overall, looking at today's topics. A lot of international trade discussion. We have quite a few emerging items on that. I guess starting with USDA, they recently released their expectations on ag trade deficit. And, historically, the U.S. has not really operated in a deficit. This is something other than a few outlier years that's been, hitting consistently since 2022. But looking at the expectation from USDA, it's $49 billion, which would be the new record for that, looking at this marketing year. And really, it seems to be on the balance sheet. We are comparing apples to oranges here. We're looking at purchasing, these, or not commodity crops, but these or food crops, looking at like avocados and other food items. But our ag goods that we're exporting really aren't keeping up, both market wise or dollar wise. So, how do you see this playing out? And what does this mean for U.S. agriculture at this expected deficit value?
Well, so this is a good question, right? And there's a lot of people that put a lot of focus on these trade balances in terms of how much we're selling versus how much we're buying from other countries. In some cases it is similar products, right? So like we import, spirits and alcohol from Europe and other places around the world, but French wines, Spanish wines. We have a viticulture industry in the U.S., and so this does directly compete with that industry. However, so like I guess I would say is like some people would sit here and say these are direct competitors to the same product. Why are we importing spirits and wines when we produce that here in the United States? And on the other hand, there's producers that, or there's people in the United States that are sitting there saying, okay, it's not the same product. If I want a Pinot Noir, I'm gonna, I can buy from here. If I'm looking for a really nice, Chenin Blanc or something like that, I might go here, right? So like
By
there's
definition, you have to buy champagne from France.
yeah, so there's another example, right? Like, and so the ag trade deficit is just it's one of those things that draws a ton of headlines. And in the short run, yeah, what's happening is we're importing a lot more specialty and high value products than what we used to. Whether that be fruit and vegetables, whether that be alcohol and alcoholic beverages. And that's what's leading to a wider trade deficit. Plus, we're not shipping, as much of certain commodities internationally as what we used to. Soybeans is a category, right? We're consuming more domestically, and so we're just not shipping more. And then for a lot of other row crops that we ship a lot of bulk, right? Large volumes. Those values have come down, right? Like we're not shipping $5 soybeans anymore. We're shipping $4, soybeans at the port. So there's a lot of things that go into these trade estimates. Truthfully, I don't know if it really is, like, I don't know how to look at this and tell you what to think, because it is such a product by product, country by country thing. And it's largely driven by consumer appetite for high dollar products.
Yeah, well, and looking just at the, how these things directly relate on the futures market side, looking at ever since the open on Friday, I guess, we've seen corn, for instance, go from around 480 to now down around 450. We've seen soybean futures go from, in that 10-30 range all the way down to about $10, now just below $10. So Ben, like these things, obviously they're swaying the market pretty heavily. We're seeing other news items coming out. I think yesterday Trump announced on social media to expect tariffs hitting U.S. ag exports in early April. We just had China this morning announcements of them hitting U.S. ag goods. We haven't looked too far into that to quite figure out exactly what goods they're hitting, but we're looking at 10, 15, 20% tariffs on certain products that are obviously going to impact the bottom line of U.S. agricultural producers. So as you see this play out, I don't want to say it's just going to be a rerun of the trade war with China looking at 2019, 2020, but what early expectations should we have for what these trade rubs, what they should look like?
Well, first, I'm going to talk about why we've seen such a softening in commodity prices. So we did see USDA release their 2025, 2026 tables for corn, soybeans, cotton across the board last week at the USDA Ag Outlook Forum. And as kind of expected, they show corn acreage up, and it was actually a little higher than where the market had anticipated. And so that changed that sentiment. We talk about market sentiment a lot. That was one of those things to where all of a sudden people stopped thinking about demand for the old crop, and all of a sudden we started talking about how big or how large the size of the new crop could be. And so that was really what kicked off this spark of deterioration within the futures market, was kind of the Outlook Forum numbers. To your question about the trade standpoint, there's a lot of headlines. We've seen a lot of news come out about tariffs and trade. There's a lot we don't know. And I always say that, I'm not trying to cop out of the question. There's just so much we don't know about what products and when and how. The one thing I will say is I think it is already starting to affect ethanol just a little bit. We did see this last week. The ethanol stocks number in the U.S. just spiked to 2.5, or well, excuse me, all the way back to April of 2022. That was, excuse me, not 22. 2020, right after the pandemic. Ethanol stocks are at some of their highest levels since we stopped driving and consuming. And it wasn't consumption that was the problem this time, not using product. It was Canada not buying ethanol. And so, if you lose kind of an export market, Canada's, our top buyer of U.S. ethanol. If you lose a top market for that, all of a sudden now we've got growing stocks on the ethanol side. That's going to further suppress those margins. We'd already seen really weak to low margins for ethanol plants. And so, my expectation is that ethanol consumption or ethanol grind really starts to kind of taper off here for a period of time this spring. But that's one aspect of how this is kind of playing out, right? No one was talking about Canada and ethanol, or very few people were. But yet they're a big buyer. They stopped buying. It's caused ethanol stocks to grow, and it's putting pressure on that ethanol market.
Ben, in some of your written content, you had discussion around Canada, and Colombia and the EU as ethanol buyers, and all of these, or a lot of these places being mixed up in this tariff conversation. So it'll be interesting to see how that progresses and develops moving forward. But Ben, really looking at the rest of this week, what should farmers and ranchers be paying attention to? I feel like there's always a lot going on as far as what the administration is kicking out right now that could sway things. Either looking at the socioeconomic things, looking at the war in Russia, Ukraine, looking at different things like that could sway it. But what reports, I guess, should farmers and ranchers be looking at that could sway the markets?
Yeah, so Wednesday of this week, we're going to get an update on state stories. The reason I like those state story reports this time of year is we get an idea of the winter wheat conditions. We saw a nice rally in the wheat market, largely just due to cold weather and concern that winter killed a lot of winter wheat. So I'll be interested to see, just kind of any update we can get in terms of what the conditions look like out in Kansas, Oklahoma, Nebraska. So that's Wednesday. Friday, we do get the U.S. jobs, unemployment, and hourly wages report. That was a report that last month kind of had a lot of interest, just from the economic standpoint. Given where we've seen consumer spending and income go, this will be another highly anticipated report on Friday as we get an update on the unemployment rate. And then this all, I think, from the grain and oilseed side, it all leads up to next Tuesday, a week from today, when USDA will release their February WASDE report. Again, not a whole lot of changes expected in the domestic market, just because they made a lot of the demand changes after the January stocks report. But if we continue to see more deterioration in South America's corn and soybean crop, that'll be, I think, matching expectations of the market. If it's held constant or even an increase, I think that would come as a bearish sentiment to the market.
All right, Ben, it's always a pleasure having your knowledge and information here on the program. Viewers and listeners, if you'd like to learn more about us and what we do, or our sister program, the weekly livestock market update, you can do so at brownfieldagnews.com. Ben, thanks again. I'm Will Robinson on Brownfield.